Okay, great. So let's have a look at company. McKesson. Now, McKesson is one of the biggest companies among healthcare-related industries. It's not the biggest company, and it's not, if you take into other company into consideration, it's not going to be even close to the big one. But the revenue is about 120 billion, I think, in 2017. So it's quite a big company from revenue perspective, and they are planning to go above $200 billion in revenue. Now, the interesting fact about this company is that it was established in 1828. So it's nearly 200 years old company. So it's quite old. And it was established by Charles Olcott. And then 5 years after that, John McKesson joined it as well. And since that, the name McKesson was put on the name of the company. And the company changed the name several times, but McKesson was all the time above it. That's why right now we have McKesson as in the name of the company, and some divisions, they always would be told like technology McKesson, some of them supply and equipment McKesson, but in general it's always McKesson. Okay, and when they started the company, they started as an importer or wholesaler of botanical drugs. So it's kind of always was related in supplying medical stuff, okay, even what was botanical herbs and drugs in the very beginning. Now, currently it has 4 major divisions. Now, one is related to medical supply and equipment. So that's the sector which affected the industry kind of name, okay, supply industry. Even though it is not probably the biggest sector division in this specific company, okay, but they supply practically to everyone. They supply to pharmacies, they supply to medical centers, they have online platform which is integrated to different health practitioners, hospitals, centers, and etc., etc. And what they do, they order it online, and McKesson delivers them. So why it is important to know? Because if Amazon, not if, when Amazon enters the space, Amazon has same services. So Amazon is online shop. So people order online and it gets delivered. So McKesson is already implemented this part. Okay, so people and their supply chain management is already in place. People already know with that. They know how to operate. So for them, it's much easier go and order from existing suppliers than try to find a new supplier, so try to buy it from Amazon. Okay, especially we have to pay attention because Amazon very often is not the supplier itself. Amazon is third party. So what they find in other supplier, and that supplier sells, and Amazon just gets some margin on the top of that. And of course, in a lot of cases, when you're choosing Amazon products, you cannot be confident about quality of this product. So, and remember that medical products is something which you definitely want to be confident in. Okay, you wouldn't buy something which you don't know if that tablet is going to work or not. So in this particular case, like this reputation has to be watched. Okay, I don't know about Amazon like health sector, how they're going to operate it, but whatever products they're selling now, quite often it's third party supply. Now that's medical supply and equipment part of the business, and then it has technology provider, and it's probably one of the fastest growing divisions in this specific company. About 50% of all health systems in US, they have McKesson, some kind of software, and about 20% of all physicians' practices, they have McKesson systems in place. 25% of home care agencies, they have McKesson business processes, and 77% of hospital with more than 200 beds. Now, the main goal of this specific software, it optimizes the business processes within those centers, companies, and different centers. So, and reduce their cost. Okay, so why it is important to know? Because for two reasons. So first reason, if like Donald Trump and politicians or legal acts, they try to push the prices down. Okay, and what happens in this specific case? So majority of companies, they will be trying to reduce cost of their suppliers, and companies which are going to survive like this type of environment, those companies which are going to implement some efficiency measures, and those companies which manage to optimize their business. So they would have to look at their business processes. They will have to look at their supply chain management. They have to look at a lot of aspects, how they can reduce cost and become more efficient. And McKesson is exactly in this sector. So the company McKesson probably will be the company of the first choice because it already has a huge market share. And when people, like when the companies, like for example, the hospital decide to optimize their processes, and they will be looking for some kind of IT solution, most likely they're not going to IBM. They're not going to go to Cisco, the companies which provide IT solutions, but they in general term, they most likely will go to McKesson because this company specifically works for that specific industry. It's one thing. Secondly, can you imagine if the company on a daily basis, all the time, does this type of business, they constantly optimize their processes. How do you think they optimize their own processes? If you optimize all the time and help other business to run, it's much easier to run your own business as well because you know how to run the businesses. You kind of look through hundreds and hundreds of other businesses. Your competitiveness on the market will be much higher. So that's why if you compare with other companies which just doing medical supply and equipment, McKesson has a quite high chance of being more competitive on the market because they know a lot of systems. First of all, they integrated with those systems and they constantly like improve them so they can implement it for themselves. So again, McKesson could be one of the best companies when situation like that happens. All right. Another division about this company, which I didn't know actually when I was investing, and only when I was preparing for your masterclass, guys, I discovered that actually they own Health Mart pharmacy franchise, and they have, it's a network of 400 independently owned and operated pharmacies. So that's why in the very beginning I told you that McKesson has several divisions in their business. So they have supply, they have technology, IT providers, and also they have retail. Okay, so it's like wholesale, retail, and IT. So that's why I believe that this company has a quite strong position on the market. And even if one area is going to be affected by some economical difficulties, another division can pull the company up as well. And also the good fact that they have international segment, Canada, UK, Australia, and New Zealand. So even though we're expecting that something might happen with these policies in the United States, most likely they're not going to straight away directly affect sales and profitability in Canada, UK, and Australia, and New Zealand. And the good thing about like it's not only medical related products here, it's more like IT technology which goes to those companies. So they're doing not only hospitals or logistic companies, they're also providing like they creating this paid software for like doctors and nurses and care assistants for different hospitals. So they integrated and providing IT solutions for all type of areas in the business. Okay, this is type of company from description point of view. Okay, put pluses is all clear about the company. If you know something about this company and you can add about it, please write it down. It would be nice to hear about that. But as you can see that it is pretty big company and diversified company. Okay, cool. So let's have a look at value line and see what it tells right now. So the price, the value line report was issued 17th of August, so it's only a few days ago. At that time, price was $126. Right now, it's $130, so it's $4 more. P ratio is 9. And value line, straight away, I'm going to show that value line believes that within the next 3 to 5 years, the company can grow to and be between $280 to $375. So they kind of predicted their move in price will be more than 100%. So that's value line prediction. We're going to analyze it ourselves, and we're going to come with our own prediction. And after that, we're going to compare. So please remember those numbers. Now, first of all, we're going to look at sales level. We're not going to look at per share, although you can do it yourself, but you will see that it's constantly growing. The revenue, they sell more and more and more. And let's have a look general for the whole company. And we can see that, for example, for the last 5 years, 12.2 billion, 122 billion, 137 billion, 179 billion, 190 billion, 198, 208. And this year they are planning to close $222 billion in sales. So it is quite a big company, and within the next 3 to 5 years, they are planning to bring this number to $290 billion, so nearly $300 billion. So they're going to increase from the last year nearly like 40%, 45% probably extra to build it up. Now, net profitability. Look at net profitability. In general, it is growing up. And if we look at the last 5 years, so we will see that it has a 1-year drop. So it has $1.9 billion here, then $2.6 billion, and then nearly $3 billion. So it has $300 million in drop, but then it's going again to $206 million, like nearly $600 million, and then to $6.4 billion. And this year they are planning to close $2.675 billion. Okay, and then in 3 to 5 years they are planning to go to the level of $3.8 billion in earnings. So that's how it works. And so we can see that sales is growing, earnings are growing as well, and also if we look at share percentage, we will see that the growth per share is faster. And the reason is simple, because they're constantly buying their shares back from the market. So we can see that there was 230 million, 231 to 25 to 11 to 102 million. And now this year they are planning to have 198 and etc. They're going to reduce. So even though if the profit of the company will stays the same, profit per share is going to grow, because the amount of shares in the market is reduced on the annual basis. Okay, and this is good for us as investors. But of course, for us, it's much better when the company is buying at the lower prices. And right now, they authorize the purchase of $15 billion, $1.5 billion of shares. They're planning to purchase it as well, so which is pretty good for us as well. So because that's kind of return for investors. Now, what I wanted to point out here, they pay in dividends, but dividends are not that high. So they're only 1.2% if you look at the current price. So it's definitely not for dividend investors, but at the same time, it's nice to get something while you're waiting until the company grows up. Now, the company has very low operation margin. So look at this. They have 2.2, 2.9, 2.3, 2.3, and last year they had 1.8. It's operation margin, and that's exactly what scared a lot of investors, because when people see low margin, and you probably know that a lot of like investors, if you read different podcasts or you read different articles or listen podcasts, they're saying, look, we're looking for companies with high margins, because high margins, they kind of tell you that company has a lot of cash and it has a lot of capabilities to survive. So if they have to give discounts, they will give discounts and they will still be in profit. And companies with low margins, they suffer. And that's true, except some companies. So for example, if we look at Amazon, Amazon has very low margin, and that's why Amazon is so competitive, because majority of companies can compete with Amazon because they try to increase and create high margin, and of course straight away their prices of different services, they become higher, and Amazon constantly keep the margin very low. So this specific company also does exactly the same, and that's why to enter this area and compete with McKesson is quite difficult, because if the new company decided to enter this market, and remember that efficiency comes with the size, the bigger the company, the more efficient it can become. So, but when you're just starting, and you understand that you have a lot of expenses and probably revenue is not that high, so you have to increase the margin in order to be profitable. But can you imagine why like a network of pharmacies will switch from one provider to another provider if they're just new and their price is higher? So I presume that McKesson is trying to keep this margin low, specifically because of that. Okay, and again, if we came back to the price pressure, so if government decides to put a pressure on pharmaceutical prices, believe me, to keep 1.8% margin, it's not that difficult. So I don't think that pharmacists will come to this company and say, look, we were selling for $100, now we're selling for $90, and we're going to reduce, we're going to pay you, or from $100 to $90, and now we're going to pay you not like $2, we're going to pay you like $1.8. It's such a significant percentage for the whole expense, like if you take expense for bigger like companies. So that's probably it will be less like effective. People won't, companies won't try to squeeze this specific company, won't attack this company because they already have quite low margins. Okay, and if you compare operating margin and net profit margin, you straight will understand how efficient they are, because look at this. Here, its operation margin is only 1.8%, and net profit margin is 1.3%. So it means that 0.5%, that's actually a whole expense which they include. And if you look at some other companies, they have 30% margin and operation margin, and then only 5% in net profit margin. It means that 25% of their margin, it goes to expenses. Whereas here it's quite low. So the company, we can tell that it is very efficient from that perspective. Okay. So then, so I hope all clear with the net profit margin. And you can see if they're going to increase even slightly, if they decide to increase like 0.5%, it drives the profit nearly 50% up. So they can affect the profit very, very quickly. Of course, it can be different way around as well. So if somebody squeeze their margin, so and instead of 1.3 they have, for example, 1, it means that they're going to lose 30% in their profitability. So that's why it's important to keep the margin on the same level, but they're not trying to increase it. So as you can see, they're planning to keep it in the same way, 1.3%. Okay. Now from that perspective, they have quite high debt, $9.7 billion. If you take in capitalization, $25 billion. Now it's nearly 30% capitalization, but at the same time, look at their capitalization. Capitalization is quite low right now because of price. If the price goes up, even like 20%, so the level of debt, it becomes like normal. It's not that big. And also, if you pay attention to the total cash flow. So if we look at cash flow, earnings per share, it's 13, for example, $12 last year, $17 cash flow. So it's 1.5 times higher than earnings. So if we look in general, net profit for last year was 2.6 billion. So multiply it by 1.5. So cash flow was higher. So it means that the cash flow was about what, $3.9 billion. Okay, and their debt is $9 billion, $9.7 billion. So how many years, guys, company, if they decide to pay all their cash and cover the day, 3 years, correct, Andre? So it's not that bad. I mean, they can serving their debt quite quickly, and even if they decide just to pay their profit off, so they can do it quite quickly. But I don't think they're going to do it, because another thing which we have to pay attention, it's return on share equity. And remember, Warren Buffett is always trying to find companies with a return on share equity more than 20%. Here, return on share equity is 27% last year, 23 before, so it's constantly above 20, at least for the last 6 to 7 years. And they're planning to do exactly the same in the future. And what it tells you that if the company keeps a dollar, so they made a dollar and they keep a dollar, it means that they're going to return 27%, 27 cents on that dollar which they keep there. So return on share equity, because that's whatever they share equity, whatever they keep there. All right. So, and that's why their dividend is low. And of course they can pay their debt, but if debt is only 5% annual, would say pay, or 7%, whatever they pay, it means that they're making much more money. So for them, it's good not to give money back and use it for their own operation to expand their business, because they generate more cash, more revenue, and more profit. And then already when they decide to give the cash, they can always give it back. Okay, so that's why probably they work with this level of debt. Okay, guys, is it all clear on that specific terms? Can you put plus if all clear on that part? Okay, great, fantastic. So let's have a look at another part of value line. So, and let's have a look first of all at current position. If we started talking about that, we can see the current assets 3.8 billion and current liabilities like 38 billion 200 million and 38 billion 300 million. So actually they're negative. So their assets less than liabilities, and it's not kind of good thing to do that. Okay, and because we're trying always to have the company which have higher level of current assets than liabilities. And the reason for that, why? Because I mean, if somebody comes to us and request to pay them their money back, and if you can't do that, so you will be in trouble. Okay, they can sue you. But probably this specific company, it's quite strong in this position, and they can manage it, because if you look at the last couple of years, it was exactly the same situation. So it was even kind of worse, because it's 36 billion in current assets. No, it's actually better. It was better, because $1 billion, not 1 billion, but yeah, here it was 1.3 billion dollars in plus. Assets were bigger than liabilities, and this year it's kind of in a negative. So it's kind of the thing you have to pay attention to. But again, we see the cash flow is pretty stable. Most likely they just spent all their cash in order to buy back shares and I mean, pay dividends and invest in the activities. At the same time, they have about $2 billion in cash. So if somebody comes, they probably are in position, they're in position to pay it back as well. So let's have a look at the growth rate. If we look at last 5-10 years, so we can see that sales growth was in average 11 years and earnings in average 14 years. So their earnings were growing faster than sales. If we look at the last 5 years, we can see that this percentage increased. So it means that for the last 5 years, the company was actually moving faster, like growing faster than in general in 10 years time. So and average was 13% in sales and 14.5% in earnings. Again, earnings were growing faster, which is good for us. Now, in the future, they reduced their projections. So they're telling us that they're going to grow 8.5%, which is still pretty good in sales, and 10.5% in earnings. Again, earnings, they're planning to grow faster than sales, which is always good. Now, the question is, can we trust them? Can we trust that they're going to go with that type of level? Can it be the situation that they're going to grow with 5% or 6%? Now here it's probably 80%. Say 80% earnings predictability is correct. Now, first of all, that's one thing. So 8 out of 10 times they're right about their earnings. So that's already good, kind of trust. But at the same time, if we look at track record, they always was growing 11 to 14%. So why not they grow 10%? I mean, if we looked here and we saw the situation 5% and 6%, and now they're telling us 8 and 10%. So that's where we have to be suspicious, because if the company never grew on that level, why would they do it now? Okay, but if the company was growing like 13 and 14%, and when they are telling, look, we're going to grow, but not growing as fast, you kind of can trust them because they already had that experience. And most likely, this 80% would be attributable, they might make better. Okay, they might grow better than that, and then that would be 20%, because 20%, remember, earnings predictability, they can tell you that they might make $1 and make $1.1. So this earnings predictability can be wrong in both ways. Correct. Absolutely correct, Andrei. Slowing down is a sort of natural for whole, like different businesses. And when the company growing bigger, of course, it becomes difficult to like entry, because if we look already, it's nearly 50% of IT technology in like in the United States. So where they can grow, I mean, there are other companies, and I presume you understand that to switch from one supplier, IT supplier, to another IT supplier, it's very difficult. And it's not only difficult because of IT solutions, it's just cost very high as well. And I presume like some guys, if Max is here, can like, and some guys as well, so who work in this industry, you probably support me on that. If you decide to switch from one company to another because, for example, they are providing cheaper services, and it takes for you so much money to do that, because you have to what? You have to, first of all, update whole systems. It costs a fortune. It's one thing. Then you have to retrain all your staff how to run the new operational system. And then you have no guarantee that the new supplier is not going to increase the prices in 5 years' time. So, and all this switching cost will be useless if you do that. So that's why a majority of companies, if they stuck with one supplier, IT supplier, they already keep them. Okay, they're trying to bargain prices, negotiate prices on a certain terms, but switch, no. Switch is very difficult to do that. So that's why it's kind of good for McKesson, but at the same time, it will be difficult for them to enter new companies, which, for example, companies like Cisco, Johnson & Johnson maybe, or other companies, they already have their systems in place. Okay, so it's like a both ways. But MCK can grow where? If we see they already implemented their products in Canada and they're growing there, if they're already doing in United Kingdom, if you're doing like in Australia, New Zealand, so that's where they can keep growing, because small countries, I mean small countries in the sense of technology and etc. It's like in general United States considered to be one of the best in that field. For them, it's much easier to entry those, and kind of they have negotiation power and the size, they can offer better like terms for a lot of stuff. So this is good. So we can see that companies continue to grow and planning to grow in the future as well, which is good for us. Okay, and if we look at where the company is working and who owns the company, we will notice that Wellington Management owns about 10% of the company, Vanguard 7%, BlackRock 7.8%. So these companies, they are long-term investors. And you can see they own a big chunk of this company. If you go to NASDAQ and you look at the general ownership position, you will notice that 90% of the company owned by funds and money managed funds. So it's only 10% by private investors and small funds. And directors and officers and directors, they own less than 1%. So not that a big amount of invested money. Okay, value line is already mentioned. They see in this strong appreciation potential for 2021 and 2031 stretch. Okay, so in this particular case. Now, guys, that's fundamental information about the company. Before I show you results of our calculations, so I just wanted to ask you, what's your opinion, especially guys who are just new, who first time in our masterclass, have never seen this type of kind of review of the company. What's your opinion? Is it a good company or not? Is it undervalued company or not? So can you please, like, especially Peter, you're analyst yourself, so what do you think about this specific business? So please, like, share, because that's kind of discussion webinar. It's not only me giving you information. So I really, really appreciate when somebody express their opinions as well. And because you might know about this industry and this specific company much more than I do. So, and of course, we invest money. So, and if you find something which I missed, so I would appreciate it a lot. Okay, guys. So what do you think? Is it a good quality company? Is it undervalued company? So okay, Max, good and undervalued. Cool. Don't be shy, guys. I won't continue until you type it. Okay, good note under. You can put numbers. Whoever can know numbers, do that as well. Okay, not sure at the moment undervalued. I've come to the webinar late. I'm familiar with the data. However, from the bit I've been here, for my sense, it is works worth a look. Okay, good. It's like real analyst answer, Peter, and good, but the price is expensive to buy option. Okay, Gina, it's remember expensive. It's always the price is expensive. We'll have a look, by the way, at this trade as well. So expensive or not expensive. Okay, perfect. Now, if we do our spreadsheet analysis, express analysis, that's where we're coming up. So 42 points for quality. So it's good company, it's good quality company, and of course it is. Like, I mean, the most amount of points we always give for growth trends, and the company is growing. The company was growing in the past, it is growing now, and it's going to continue to grow. So that's why it gets the highest amount of points. Now, the debt, yes, it's lost some points on debt. Instead of 8 points, it gets 4 points. Now, safety is a good safe company. Now, timeliness. Now, Value Line believes that within the next 12 months, the price of the share might stable because of uncertainties which right now with that specific industry in general, and also industry rank, we lost a couple points here. That's where we lost the points, but from the quality company itself, from management perspective, it is a very good, strong company. Okay, so that's why I get 42 points. It's not ideal, but still very strong, fundamentally sound company. Now, from price analysis, I want to go through this more specific because I can see the different opinion here, and I express my own opinion. Remember, it's my own opinion. Now, if we look at the last 5 years, and for us, it's important. Okay, at this particular moment, we're taking valuation based on earnings of the company. So, how much people paying above their earnings? So, if the company makes $1, okay, how much people are paying for that $1? And if people paying 10 times, it means that they're going to pay $10. If they're paying 20 times, it means that they're paying $20. So we're going to look at average how much people were paying for earnings in that specific company. So, and the way we do it, we look at the highest points within year. So every year, because the price changes all the time, but the earnings, they are stable. They are all the time. So we're going to look at this. So if the people paying $166 5 years ago, and at the same year they were paying $96 for the same company, and the earnings were $8. So what we do, we can calculate that at some point, if 96 divided by 8, we get what, around 12, right? And if 166 we divide by 8, we get around 20. So we can tell in this particular case that during that year, some people, like at some point of the time, in average, people were paying 12 times of their earnings, and sometimes they were paying 20 times of their earnings. Now, we can do the same thing, same calculation for each year, and do it separately. Or what we can do, we can calculate the average. And the way we calculate the average, we take the highest prices for the last 5 years, every year the company went to this level, and then we take the lowest prices during 5 years. Then we add them together, divide by 5, and we get average high. So average high was $200, because you can see the price in 2015, it was $243. And so the average was $200, and the average low $132. It's actually higher than current price. So, and then we also do the same thing with earnings. We add all the earnings for the last 5 years, add them together, divide by 5, and we'll get average earnings. So now we know average high price, average low price, and average earnings. And now we're trying to calculate the average price earning ratio. So price earning ratio, for those who don't know, it's the ratio which tells us like what kind of multiples people use in order to pay for their earnings. So if the company is making $10, sometimes they pay $130. So it means that PE ratio is 132 divided by 10, around 12. So it's 1242. So in average, when the company was at the bottom, at the minimum, in average for the last 5 years, they were paying, in the worst case scenario, when everything was pessimistic, people believe that the company doesn't have potential to grow, etc., etc., they were paying only 12 times of its earnings. Now, when everything was rosy, everything looked good, people were positive about this company, news were good about company, of course, straight away they paid more for the specific company, and that's where the price was. We divided 200 by 10, and we come up with a number of 20 times. So we can tell that within last 5 years, sometimes, and it's nearly every year, people pay 12 times of their earnings, and sometimes they pay 20 times of their earnings. And if we believe that that was the case for the last 5 years, we can expect that something like that might happen in the future. Okay, so people, when everything is going to be bad and depressive and etc., people are going to pay 12 times of average, like of the earnings. And when everything is rosy and good and stuff like that, people are going to pay 20 times of their earnings. So the only thing for us is to know how much company is going to make in the future. Okay, and then we can multiply it. So, and then we're going, okay, fine. The company is planning how much, and the company announces that they're going to make $20.50 within the next 3 to 5 years. So that's where the company is going to plan. So we already established that the company is constantly growing, and we can trust it in their earnings, because the earnings predictability rate, it's based on their past performance, whatever they promised and whatever they achieved. Okay, so that's why we kind of say, okay, fine, assuming that they're right, and they're going to make $20 per share. And assuming that sometimes in the future, when everything is going to be nice and good about this company, news are good, people are going to pay 18 times of their earnings, okay, so 18.7 times. So we multiply it and we come up with the number $384. So the number is based on the fact that the company is going to make $20 and people are going to pay 18 times of their earnings, which was established that they did it in the previous. Then we say, okay, fine, that's the best case scenario. What's the worst case scenario? What can happen? Okay, we say, okay, fine. The company was, people paid 12 times of their earnings in average, like sometimes it could be even lower, but in average 12 times of their earnings for the last 5 years. Okay, and what's the actual earnings? So in this case, we are not projecting earnings. We taking whatever we have right now, and we have $12.65. So we look at last year earnings. Even though today, this year, they are telling that they're going to make $13.5, we still paying attention only to the previous year, so lowest number. Now, if they had projection of dropping earnings, so we will take that number, the worst case scenario. But in this particular case, the worst case scenario, it would be last year earnings. Okay, what do we have? We multiply average PE, multiply by last year earnings, and we come up with a number 156. So if based on the analysis of previous 5 years, we can expect that the price can vary from 156 to $380. And if we look at this range and kind of believe that 30% of the time, like 1/3 of the time, the price of of this specific share is going to be close to the lowest number, 1/3 of the time it's going to be somewhere close to the top, and 1/3 somewhere in the middle. We create 3 equal ranges, okay? And we can assume that between this number, company is going to be 30% of the time, between this number, 30% of the time, and between this number, 30% of the time. So if we're going to buy, we're definitely going to buy closer to that number, somewhere in between risk range. So buying range, then we holding range, and then selling range. Now remember, this is for long-term investors. Okay. Now the question is, what's the price right now? So if we are happy to buy from $156 to $230, guys, what's the price now? I already mentioned it to you. So the price, current price, is $130. So based on valuation, it's actually lower than the lower, because PE9, it didn't exist. Sometimes, probably, when this kind of, if we look at PE ratio, and if we look at the gray area, which was recession time, okay, we can see that here PE ratio was, where is PE ratio? 11.8. I assume that's average for that year. So sometimes during that year it might be like 14, sometimes it could be 8. So we can expect that in that environment, in the depression environment, the PE ratio was so low. And at the moment, we're repeating the same type of situation. So actually, if you look at the last, well, whatever, from 2002, we can see it, company never had PE as low as now. So people never paid as little for this specific company as they pay for this now. The question is now again, guys, is it undervalued company or overvalued company? Undervalued, definitely undervalued. And we understand the reason why they're undervalued, why the price of this specific share is so low. It's not because the company performing bad. It's not because they are losing the market. It's because political environment and because of fear of of other company entering the space like Amazon. And like from our past experience, we know that those rumors, they just run away in the future. Like, I mean, they're here and then they disappear. And majority, they're created because people don't really know how to analyze the fundamentals of the company. Okay, guys, is it all clear about this specific company? Put pluses, it's all good.